Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Jean Boivin joined us, absolutely definitive at BlackRock here, global head of research for BlackRock Investment Institute, and with a real Canadian feel as well. Jean, I see the moment here. I was reading very carefully Wei Li the other day, synthesized the BlackRock view of the software shock of 4, 5, 6 days ago.
Yeah, I think it's interesting maybe to start by comparing this to last fall, right? So last fall we had markets selling off, and that was all on the back of doubts about whether AI was a real thing. And now we got this kind of, as you say, shock over the last couple of weeks, which is also a sell-off story, but it's because of AI is a real thing this time, and now market extrapolating to the disruption it's going to really cause. So I guess one takeaway is that we see that as increasing the conviction on this AI mega force being real. It's happening. It's disrupting now. And now markets are starting to think through what that means for winners and losers. I think it's early, though, on that question. So we're going to see markets start to run to conclusion and make big, sweeping software-type labels on stuff and run with this. But I think it's going to be a story that's going to, be much more nuanced. And, I think we're going to likely to see overreaction along the way, as we've seen.
Jean, I'm wondering if this market can perform if technology is not leading it. We've become so accustomed to technology, and then most recently, the Magnificent Seven leading this market. Do you still have confidence that that's the case?
Yeah, well, I mean, we in our outlook we call that micro is macro, right? So the idea that it's a mega force story. AI is at the center not only of this market but of the economy, to be honest. So the growth we've been having and we're going to continue to have is heavily dependent on AI continuing to grow. But I would say that what we've seen over the last couple of weeks is now visibility into that breaking out of the pure kind of builder. So yes, we are focused on the potential losers, but that means that they're losers because there's going to be windfalls. They're going to be very significant for the others where it's going to get monetized. So I think we're going to heavily dependent on the AI story. I think the build out, the need to build this out is that thesis is intact, even maybe reinforced, and that's an hyperscaler story.
See, Jean's just killing me.
He knows what's going on. He
goes, micro is macro. I got to shift to a Fed discussion. Jean Boivin with us with all of his great work in academics at Princeton. Does Kevin Warsh have any understanding, Jean Boivin, of the micro dynamics of monetary policy study? Or is it all big concept stuff?
I mean, I don't know that I have visibility into that specific question. I think, I've known Kevin for some years, and I've followed his comments and so on. I guess one thing you could say is that this is certainly somebody that has a macro view of monetary policy that is incurred in crisis experience, and I would say that has a good understanding of the global ramification of that. So I guess that's an important point. And he's also been very focused on the AI piece, which I guess is more of a micro lens on things. So that would suggest that both are at play here with Kevin.
And what's really interesting here, we had another guest in earlier who's talking about the productivity boom as not only AI, but as efficiency learned off the pandemic. Describe how you see America's burgeoning productivity.
Well, I would say that the productivity we've seen in the data so far, to our mind, has not much to do with AI yet. So I think I would be more sympathetic to, what we've learned from the pandemic and that feeding through. And also, I think a big part of this is just cyclical. We are when growth is accelerating, we tend to be more productive before we hire more people. And there's also this kind of no fire, no hire dynamic with the uncertainty that I think manifests itself in increase measured productivity. So first point is I don't think we've seen the AI productivity yet. I do think that this is the potential is real, right? I mean, and I think it's going to take some time to see it. But like we think for the first time, it's conceivable that AI could be powerful enough to finally break us out of a 2% growth world, which we haven't broke in the US for 150 years. All the ingenuity of humans over the last 150 years has just been enough to keep us on a 2% growth path. I think it's conceivable that AI for the first time could change that. And the key thing will be if it actually leads us to accelerate the rate of innovation. That's the key thing to track for us. But that I don't think we've seen that yet.
Jean, 2025 was a year where emerging markets really asserted itself as a performer here. Is that going to extend in 26?
We are positive on the emerging market for 2026. I think the macro backdrop continues to be positive for EM in general. We have a weaker dollar environment that I think we're not like subscribing to the idea that there's an ongoing kind of trend downward on the dollar in 2026, but I don't think it's strengthening either. So I think that's going to be conducive, constructive for EM. We have a policy landscape in EM that has been surprisingly strong over the last couple of years. I think that continues. And for us, then it's about tracing those mega force and how they play out in EM. So those that are exposed to AI, I think are set to do well. Korea is obviously like the super story of 2025, but I think that has some room to continue.
What is the study at BlackRock, Jean Boivin, of China? Have they finally recovering? We're seeing it in retail a little bit. Karen Gucci out today with a better tone, but does BlackRock see a China doing better?
I think the marginal evolution is towards a more positive investment landscape. I think and there's a couple of things. I think the AI story again. I mean, there's more than AI in life, but that's the key. That's certainly the key thing right now. And it's also true in China. That's a key thing. I think we have not paid enough attention in 2025 as being a big story, and it has really been pretty powerful. I think the other key drivers are, yes, there's a bit of a broadening of growth that could be part of it, but I think also the authorities shifting their stance on corporate China and allowing maybe a bit more breathing room, I think, and learning those lessons from the last few years could also be constructive. So on a tactical basis, we see more opportunity in China than we would have seen a year ago.
Jean, thank you for the time, particularly those comments on the Federal Reserve nomination process in the U.S. Jean Boivin at BlackRock. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Through the week here with all the government shutdown, short shutdown, nice restart. But the economics forward through the week is exhausting. To help us out, Frances Donald joins us right now. Thrilled to have her with us here this morning with RBC. I look, Frances, at where we are, and I got to get to Friday. Do you have any guesstimate or bestimate of where you'll be Friday? It's a 8:45.
8:45. Well, we will be still reviewing the CPI data, but probably taking the entirety of the week together, which is we've got retail sales. We've got a jobs number coming through. We've got inflation. And yet behind the scenes, the problem is a lot of our data is still distorted coming off of the shutdown. We've got seasonality issues, which we always do in the first quarter. And then we have a lot of known unknowns, like where is tariff policy going to settle? We still don't know the answer to that. And we're wrestling out with all of these data points. What is a cyclical trend versus what is a structural? That's never been more important in my career.
Smart people in Atlanta have the Atlanta GDP now, which is now. It's coming down. Is that a vector in place? And are we going to get real GDP under 3%?
oh, we're probably going to get something for the fourth quarter around 3%, maybe a little bit of upside about that. But again, what is the composition of that growth? We're seeing growth that is great for markets, but not great for the people. We're seeing growth that is really biased towards CapEx, AI, data centers. Now, that's not necessarily bad. It's just a different type of growth. It's not a tide that lifts all ships, and it's not one that's going to create a significant amount of job growth associated with it. It's not growth that's going to save the affordability issues facing consumers. In fact, it's not growth that's going to solve the K-shaped elements of this economy. So it's growth, and that's good, and I'll never knock a great GDP number, but what's happening under the surface is going to be far more important for companies operating in the United States and ultimately for markets too.
I like in your notes, you say we are about to hit the 5-year anniversary of inflation running above 2%. I didn't think about it in that terms. The Fed can't be happy about that. But B, who cares about 2%? I mean, where did that number come from? And should we really care? It feels like inflation, it's higher than maybe we'd like it, but isn't it just kind of where we are in this economy?
Well, I guess that's a great way to put it. That's kind of where we are. Where does it come from? Central bank research, predominantly, I think, originating out of New Zealand. The 2% was a great place to be. Right. And I remember even a few years ago, folks would say things like, oh, well, what if we end up with 3% being the new 2%? And this was a really scary type of development. But when I think about 3%, I think that, well, people got worried about inflation surging like it did during the post-pandemic period, 9-10% as being the real big problem. But here we are actually sort of embedding higher inflation expectations going forward. And the issue is, based on our outlook, we're going to stay in the high 2s and around 3% through the end of this year. So it wouldn't surprise me if you had me back a year from now that we're celebrating the 6-year anniversary of inflation above the 2% target.
All right, let's go to the other side of the Fed's mandate, the labor market. We'll get some labor data this week as well, and the unemployment rate, I think the forecast is for 4.4%. Again, that feels kind of full employment-ish, although you tell that to a recent college grad, and they probably wouldn't feel that way. So how do you feel about the labor market?
Full employment-ish, I'd say that's downright full employment right there. There's only 2 periods in history when we've had unemployment rates that were this low. We actually have a 4.3 in our forecast for this week, but 4.3, 4.4, we're sort of splitting hairs here. So what's happening? Well, we are going to have far less job creation. You're not going to see new jobs being posted. So non-farm payrolls, those are going to continue to decline. We have about 65,000 for this week coming through. Could be lower, and it will trend lower through 2026. Right. But that unemployment rate is not going to rise meaningfully. Why? Because there are not enough people who need new jobs. Coming forward, we only need to create about 40,000 jobs per month or less in order to keep those who want jobs with jobs coming through this year. That's going to take a lot of re-education for markets to really understand.
With the Royal Bank of Canada, Francis Donald with us to get us started. Is joining Thierry Wizman on deck. In the next hour, Andrew Sliman from Morgan Stanley, Ian Bremmer in the 9 o'clock with Jean Boivin, BlackRock. Just a fabulous set of conversations today to launch into February and March. I'm going to digress here now for 30 seconds. I think it's very important. One of the great moments for your Canada was to see the Quebec Nordiques on the ice with the Montreal Canadiens here. Of course, the Colorado Avalanche play. Really emotional, actually, folks, to see these two teams. Pitchers and catchers right now, do we need to see Montreal Expos next year at pitchers and catchers?
Sure, let's go for it. I have to tell you, just over this weekend, my husband and I were having a conversation that everyone wanted gold, everyone wants critical minerals, everyone was running after silver, whereas up in Quebec, we're always running after Nordique swag. We just want Nordique hats and sweaters, and if we could monetize that, we could actually beat this market.
When you were a kid, did you see the Expos? Do you have any memory?
Of course we saw the Expos. We saw Yuppie, who was the mascot. It's still embedded in my Montrealer blood.
It's like up there, it's like embedded in it.
It's like hockey Expos, in skiing on the mountain and being cold.
Back on track here with economics, finance, investment with Francis Donald. I look at the makeup here, and the number one thing I get from our listeners and viewers, you guys are idiots. The unemployment rate isn't 4%. We had somebody a couple days ago say the unemployment rate calculated around hiring, a dearth of hiring, is 8%-ish. What does our unemployment rate feel like right now?
Well, it depends who you are. I mean, Paul, you highlighted young folks right now. We've seen a huge surge in what we call youth unemployment, those under the age of 25. That's not just an American phenomenon, by the way. That's happening globally. Maybe some AI issues in there. Maybe some hesitancy around how much will tariffs actually burn us. Should we be bringing on new labor here? But we have another theory as well, which is we talk a lot about this no hire, no fire environment, which is so atypical. But there is a shadow hiring market that's happening in the background, which is that if you retire, and we know there's mass retirements, about 2 million folks in America are retiring every single year right now. That's 60,000 folks more per month than before 2 years ago, a delta of 60,000, and you bring in a young person to replace that role, it will not count as new job creation. It will not come up in non-farm payrolls. It will actually just be a replacement hire. So we know that there's hiring happening that's a little bit more in the shadows than where we see. And Tom, I'll tell you again, like if you are in trade or manufacturing right now, your unemployment rate is higher. If you're in healthcare, the job market is extraordinarily tight. So my friend and colleague, Amy Wu Silverman, I think here yesterday, friend of your show, she has this metaphor of a duck that is calm on the water with the feet paddling underneath.
You're going to redux this today.
Oh, I'm going to redux it because it's a brilliant way that she describes it. It's also how the economy is operating with that unemployment rate stable on the surface, but extraordinary churn and transition happening underneath the surface. So it makes sense that Americans feel like they're not well represented in the number, A, because the number's not telling us the whole story, but also because there's this huge fragmentation underneath.
Retail sales, we're going to get 8:30 this morning. How's the consumer doing out there, do you think?
Well, the consumer is muddling through. They've got real wage growth around 1%. That's enough. They have jobs going forward. So you'll be okay on retail sales. But again, incredible fragmentation underneath the surface. High income consumers holding up a lot of the rest, but not entirely. And I think this is the challenge, is that we're looking for a lot of cyclicality in that consumer that's going to be reduced, because if you want a job in America, you probably have one on average. Again, we talked about some other areas. So for a very long time, economists would say the best way to measure the growth of the U.S. economy is to say, if a consumer is employed, then all is right with the world. The consumer is 2/3. But that is no longer going to be the way that we measure the strength of the American economy or the way we measure the strength of the consumer. It's going to be, what type of job do they have? Is it enough to offset the cost of living? Again, 5-year anniversary of inflation above 2%. And what sectors are actually seeing some of that strength moving forward? So I'm looking for more information on that today.
From the Canadian perspective, where are we on tariffs here? Because I don't think we've heard a lot about them recently. I mean, we had the Greenland thing a while ago, but from your perspective, the Canadian perspective, what is the tariff situation? Well,
it depends what country you're speaking from. Okay. And actually, trade policy is still very much in flux, right? We have the IEEPA Supreme Court decision that may come through. Yep. We have USMCA. Mexico, Canada, and the United States are up for review of this very important trade document. And of course, every day we see new information about trade deals that the U.S. is embarking on. So our view is that actually American companies are not sure where tariffs will land. Will they get reduced? Well, and that's really implicating or slowing some decision making.
You've been brilliant on this. And the answer is we were at 2 to 3% blended tariffs. We did a jawboned moonshot out of the Rose Garden up to some ginormous William McKinley Gilded Age number. And there's a beautiful chart in the FT, I think Toby Nangle had it, coming back down, and we're at 10-ish right now.
Yeah.
For you, what would be the number to come back to where you'd say we'll survive? Do we need to get back to 2 to 3%?
Well, I think the issue with tariffs is we always think about them in absolute, as if it's the only shock happening to the U.S. economy. And so I hear all the time, well, look, tariffs didn't impact the U.S. Inflation is, high 2s, about 3%. The unemployment rate is fairly well contained. Where was the big, hoopla that economists warmed towards? Well, number one, I still think it's early. So companies, we believe, held on to market share over the holidays, and you're going to actually see tariffs rise into CPI data into the second quarter of this year. So it's too early to say we didn't see it. But secondly, we have seen this impact. We've seen it in rising goods. We've seen it in layoffs in manufacturing and trade exposed sectors. And I think the better way to think about this is if we hadn't had tariffs come through, you would probably see higher growth, you would see lower unemployment, and you would see less inflation. So you have to compare it to what would the world look like without tariffs, not why didn't the economy break as a result.
So given all that background, what's our Fed going to do over the next 2, 3, 4, 5 months, do you think?
2, 3, 4, 5 months. Well, we think that they're going to stay on hold just because they won't have enough data to justify cuts. I mean,
you're saying hold into the end of the year?
We do have a hold call through the end of 2026.
Wow.
Now, here's the challenge. It's going to depend on some of the biases within the committee and how reactionary they're going to be, because the unemployment rate is going to take up a couple beeps here. We could go from 4.3 to 4.5. Do they feel the need to react to that while inflation is still high? But the window to do this is probably not going to appear until later in this year, because again, you are going to see inflation stay really high and goods inflation rise into the second quarter. But I've been around a few Feds now, Tom. You and I together have seen through a few of them, and there is enough variation in the data. There are enough subcomponents. There are enough core CPIs taking out XYZ that if this Fed wants to cut and bring rates closer to their estimate of neutral, they could find a number for it. But our call right now is that they won't have enough sufficient data to do so.
I'm not read in on this, and I assume you are because you're Francis Donald who knows all. There is a bridge to Michigan.
There is.
Named after the Fabricant Foundation of Detroit, Gordie Howe. I never saw him play. I saw Cam Neely, who I was told was the closest approximation. The Gordie Howe Bridge has become a political pawn.
It has.
What would, this is a terrible position for you, but how should Canada and how should Mr. Carney react to what President Trump says about that bridge and that magical name?
Well, I don't think they need any advice from me. They've been managing the trade relationship for over a year. But the challenge is that Canadians and many trading partners across the world wake up to new Truth Socials all of the time. And what we're seeing here is probably a prelude to the USMCA mandatory review. Now, this review of the USMCA would have been in place no matter who was president. This was put in. It's supposed to expire in 2036. And this is a conversation about whether or not to extend it. But if you look through to the Americans right now, what they're asking for from Canada is not largely deal breakers, things around dairy, for example, perhaps digital services taxes. None of that's happening here is probably going to railroad the Canadian economy, but it's going to take up an enormous amount of headlines. And if you're a Canadian or American company doing business with each other, it's probably going to weigh on your ability to make decisions.
I saw a photo of the Canadian hockey team in front of the Duomo in Milan. Are you kidding me? With the total aggregate payroll there is the GDP of California. I mean, Canada, U.S., you got to go with Canada, right?
Well, of course, I'll always go with Canada. Are you speaking to the heated rivalry version of the Canadian economy, a Canadian hockey team, or the real life one?
I don't know. I'm looking at Sidney Crosby and Brad Marchand in Milan, and I'm like, this is going to be a hell of a game.
It's going to be a hell of a game.
Yeah.
Francis Donald, thank you so much. Really nice brief there, folks. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I was channeling Thierry Wizman as he walked into the studio because I was looking at the Japan 40 year. Where are you going to be in November? Where are you going to be in December? Looking back to February and saying, I shoulda, woulda, coulda. For Thierry Wizman at Macquarie, his expertise on global foreign exchange, it is Japan. Okay, currency's there. I guess you say we're going to see a stronger yen. But I see it in yields. The wonderful Stanley Fischer taught me, look at the percent change of the yield. The 40-year generic, the yield is in 12% from the gloom of just weeks ago. Higher prices, lower yield. What does it signal?
Well, interestingly enough, when Sanae Takaichi took over as head of the LDP in Japan back in October, you couldn't say that she had a popular mandate. And there was a lot of uncertainty about whether or not she was going to drive growth higher in Japan because she lacked that popular mandate. She was right to call this snap election because now not only is she the leader of the party, she also has a popular mandate. And I think that's incredibly important with regard to her ability to push through the reforms that could improve growth. Now, you might think that improving growth should be associated with higher yields. I think the market is realizing that higher growth in Japan may be exactly what Japan needs to bring down yields, because higher growth is what's needed ultimately to bring down that debt to GDP ratio that everyone has been concerned about in Japan for several years now. So it can also be disinflationary as well. And we know that higher bond yields are associated with expectations of higher inflation. So she's able to drive growth, bring real GDP higher, and bring inflation down potentially or stabilize it in Japan, which is very different than the policy approach under the new capitalism of Prime Minister Kishida before her, you should expect yields to come down. I think the market is finally realizing that. Look, the stock market there is up as well. Dollar-yen fell upon the announcement of the LDP's victories. I think Japan is heading in the right direction.
How will Japan do it? How can Japan fuel growth? It's been 40 years since we've talked about growth in Japan. How do they change that narrative? What's the policy, do you think?
Japan has been stuck in a demographic nightmare. So one of the things that has to happen, at the very least, is to stop, and I hate to say this because it might sound cruel, but to really try to stop spending so much money on the aging population and start to focus on the youth and the young people in Japan who are the engine of productivity and innovation. Doing that would be a good start. Another good start would be stopping this budgetary morass of continuing to subsidize a lot of these zombie companies in Japan, both directly and indirectly through the subsidies that are in the budget. I think that will spur innovation. I think Japan, we think of it as a advanced manufacturing economy, but to a large extent, we all know that it has lagged with regard to technology adoption and innovation. Other countries in the West, including its neighbor China and the U.S. I think that's the key.
It's interesting. Business school buddy of mine, was CEO of a Japanese company, just sold to KKR. I don't think I'd ever seen that I can't remember how long. I mean, a private equity company coming in to Japan and investing capital. Yeah. And on the other side, selling a Japanese company to a U.S. private equity company. Maybe that's something like you're talking about.
Yeah, well, maybe. But look, I think Japan has, if what you're trying to suggest is that Japan has a lot of hidden or undiscovered gems in its economy, I would agree with that. It's just that innovation and technology adoption have been somewhat suppressed. But think about it. It's a manufacturing economy. It's an industrial economy. That's exactly what's needed in this day where defense is becoming increasingly important in that region. It's also an economy that has an integrated supply chain, by the way. It doesn't really, at least for the respect to manufacturing, it doesn't really have to worry about getting parts and sourcing parts from the rest of the world. It has the capacity for that. And it has great infrastructure in support of the industrial manufacturing complex as well. So all those things are exactly what you need if you're going to restart the economy. What they just don't have is the incentive structure.
Thierry Wizman with the Macquarie of Australia, and of course their huge reach into the Western Atlantic and over to the continent is well, as we really consider here the Pacific Rim. I think of Damien Sassower and all the debt and all that. It comes down to a boom. Now, is something as simple as luxury, like carrying out today with Gucci, saying China has a pulse, is the arch Macquarie call out of Sydney and Melbourne that this is a time for the Pacific Rim. I've got the Japanese stock market in dollars since the pandemic, up 11.2% per year. I don't think most Americans know that.
Yeah, look, Tom, no one thinks that China is going to collapse this year or next. I think we're looking at a steady 5% growth rate in China. I don't know if I said Japan, but I meant China. That's fine. I think that's expected. If they reach that target, no one's going to get excited, but no one's going to panic either. But I think the real story in East Asia right now is Taiwan and Japan. Taiwan, because it's the beneficiary of all of the hardware spending that's coming out of the U.S., out of the Mag 7s and the hyperscalers and the data center build out. Japan, because they're potentially on the verge of a supply side revolution. If you're going to focus on East Asia and where the stories are and where the innovation is and where the inflection points are, those are the two places. I would not focus too much on China these days.
All right, given all that background, what do we do with the yen here? I'm looking at the yen from weakening from April-ish, 141 to here we are at 155. I mean, what do you do with the Japanese yen here?
I think you buy it.
Okay.
I think you take a view that dollar yen has probably peaked. The dollar's gotten as strong as it possibly can against the yen, that we're going to see a resumption of growth, that the BOJ will not succumb to demands to keep interest rates low, but will gradually raise interest rates, that as soon as growth picks up in Japan, people will become more enamored of Japanese companies. You'll see an inbound flow of capital into Japan. What you mentioned about your friend's company being sold to KKR could be endemic of a wave that's going to happen over the next few years. That's going to be strong for the yen. I believe, and I want to state this with all firmness, is that a currency will do well when the growth of the country does well, or the relative growth of the country does well, or when it's inflecting upward in terms of growth. I see that happening in Japan right now.
Taiwan Stock Index. Paul, I'd never looked at this. The Bloomberg folks, not only do you see these obscure indexes,
WEI,
but you can translate it into whatever currency you want, the Vietnamese dong or the U.S. dollar. In dollars, Taiwanese since pandemic, 20.8% per year. Is it too late to climb on board the Pacific Rim?
I don't think so. I think that to the extent that foreign investors have wanted to grab a piece of the tech story, they've grabbed it in the U.S. What they've overlooked is that all of these U.S. companies are dependent on fabrication of chips in Asia, on companies that test chips, for example, right? There's plenty of those in Taiwan, and there's plenty of those in Japan as well. So I don't think it's too late. If anything, there's been an overhang over Taiwan for the last few years on the premise that the Chinese might invade at some point, and you don't want to certainly be invested in a country in which that's facing a Chinese invasion. But if you abstract from that, and you believe, as I do, that China's not going to do anything quote unquote stupid here, Taiwan's a great story to be investing in right now.
This is way too much optimism.
Yeah, exactly.
February, pitchers and catchers here.
Exactly.
I'm worried about,
It's the most optimistic day of the year. Pitchers and catchers, opening day, that kind of thing.
Dr. Wizman comes in and kills it on the Pacific Rim. Thierry Wizman, thank you so much.
My pleasure.
Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
So if I was to do a panel, let's say some fancy place like Davos.
Yeah.
Right now, they would say, Mr. Keene, who would you like to have in your panel? And I would say Ezra Prasad of Cornell.
Solid.
And Ian Bremmer of Tulane and Stanford. Bremmer and Prasad would be lights out. The Doom Loop is Ezra Prasad's new book with really interesting discussions of stability. And Ian Bremmer owns the high ground on this with Every Nation for Itself, the J Curve, and of course, Us versus Them. Dr. Bremmer joins us from Eurasia Group. I look at the Doom Loop from Prasad, Ian, and the heart of the matter is we are in some form of stability moving to instability. Is that how you see it? There's instability out there?
Yeah, I like his book a lot. He's, more of an economist. I'm a political scientist, so I'm focusing on the geopolitics specifically. And I think it's cyclical. So I see this as a bust cycle because the balance of power is no longer aligned with the institutions, the architecture, the policies, or the values. And that's particularly playing out with the Americans, the most powerful country, stepping back from their own historic leadership. So, the good news is that that's very unlikely to get you the so-called Thucydides trap, a World War III. Historically, usually when you have a move to instability in geopolitics, it's because the major power is in decline and trying to hold on to its old system. The rising power wants to create a new one. That's not what's happening here. The United States is still the most powerful country. It's just unilaterally saying it doesn't want to be in charge of collective security or free trade or promotion of democracy or rule of law. So it's causing a lot of instability, but it's not causing global conflict.
Ian, in your notes, you suggest that these countries, historically allies and maybe even some foes of the United States, they are not decoupling from the U.S., but they're de-risking. How are they doing that?
They're primarily doing it economically. And the reason it's mostly economic is because the global economy today is increasingly multipolar, while the global security environment is still dominated by the United States. So the reality is that even if you don't trust or rely on the United States as a security ally, you don't have many good options. And it will take you a very long time, even for the Europeans who see this as an existential need. Yes, they're spending a lot of money on Ukraine, but they're buying American weapons. Yes, they're stepping up their own security, but they know, as Mark Rutte, the Secretary General of NATO, said in the last few days, how essential the Americans still are for the foreseeable future. Where when you think of the global economy, there are options. Even Canada, which is so incredibly dependent on the United States, has the ability to diversify more effectively with the Europeans, with the Chinese, with others. And that's particularly true. India, for example, the United States pushes India hard, despite the relationship that Trump and Modi have. And Modi takes his time in doing a deal with the Americans and instead steps up his relations with the EU and with the Australians and stabilizes with China and the rest. So that effort that we are seeing to hedge is mostly happening in diversifying away from U.S. trade, right, from U.S. capital. And, you know, those things, once they happen, they do have much more long-term implications.
Does this America First agenda of this second Trump administration, to what degree do you think it will empower China, empower Russia?
I don't think it's empowering Russia at all. I do think it is empowering China. Russia's dug its own grave. In fact, they've dug hundreds of thousands of them over the last 4 years of the war in Ukraine. They are weaker as a consequence. Their economy is weaker. Right. Their security environment is weaker. Their diplomacy is weaker. They're basically becoming, you know, a second-rate state that has to follow the lead of China, and that's not where Putin wants to be. Clearly, where China is actually in so many ways taking advantage of the United States being seen as unreliable. In part, that is directly reaching out to countries to improve their bilateral relations. And in part, it's stepping up China's role in these old institutions that the Americans don't value much anymore. So you will have noticed the Americans pulled out of the World Health Organization. They convinced Argentina to join them. Nobody else did. China immediately stepped up how much money they were giving to the WHO to $500 million. Why would they do that? Because if America's out, they get to be number one in influence. When Trump announced the Board of Peace, not just in terms of Gaza coordination, but as potentially a replacement to many of the of the operating principles that the United Nations has, the Chinese immediately said, we don't want to join that.
In the
Same thing.
Yeah, in the time we've got left, Ian, I think the question, I'm getting this all the time, and I'm not informed like you, as simple as I can, what do you perceive post-Trump? Do we return to what Paul and I knew years ago? Do we go to some form of amended new? What do you perceive in, say, 2028, 2030?
Well, if Trump is followed by a much more predictable and reliable leader in the eyes of allies, then I think you will be able to normalize those relations from a very different base. In other words, permanent damage will have been done. Diversification efforts will be in place. The Americans won't be leading the world the way they used to, but you won't see the continued trajectory towards chaos. If, on the other hand, Trump is replaced by a leader that is seen as not only more unilateralist, but also just as unpredictable, and just as willing to use American power against allies and adversaries alike, then of course that trajectory will continue to deteriorate.
We don't care, Ian. The only reason you're on today is pitchers and catchers with the Red Sox down at Fort Myers JetBlue Park. You were behind home plate, I saw, for the playoffs last year. What an improvement on the Red Sox, Dr. Bremmer. Can they do it again and improve further?
Well, they can't do worse than the Patriots did this Sunday, one of the worst games I've ever seen. But you got to be hopeful for my Red Sox. I've got to be one of the only Red Sox out there that's also capable of rooting for the Yankees when I see them in New York. It's a weird position to be in.
It's a weird. There's a mental health issue there. Ian Bremmer, thank you so much. Regards to Moose as well.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.